You walk into a bank. You hand over your hard-earned money. The bank thanks you, gives you a little interest, and sends you home. But here's the question nobody asks. If the bank is paying you money, where is that money coming from? Banks don't manufacture products. They don't sell shoes or build software. Yet somehow, JP Morgan made nearly $50 billion in profit last year alone. So what is actually going on inside a bank? Today, we're pulling back the curtain. We're going to break down exactly how banks make their money, step by step, in a way that actually makes sense. Let's get into it. Most people imagine a bank like a giant locker room. You walk in, hand over your cash, they put it in a box with your name on it, and whenever you want it back, it's right there waiting. That's the movie version, and it is completely wrong. Here's what actually happens. The moment your money enters a bank, it stops being your money sitting in a vault. It becomes the bank's liability, meaning the bank owes you that amount. And in return, the bank immediately puts that money to work. It lends it out. It invests it. It uses it to generate returns. This is the core engine of banking. And once you understand this one idea, the entire business model clicks into place. Banks are not storage facilities. They are money-moving machines. They sit in the middle between people who have money and people who need it, and they profit from that gap. Let's start with the biggest one, interest income. This is where the majority of a bank's revenue comes from. Studies show that roughly 57 to 60% of a typical bank's total income is generated through interest on loans. Here's how it works. In the simplest possible way, say you deposit $10,000 into your savings account. The bank offers you 1% interest per year. So at the end of the year, you earn $100. Now, the bank takes that same $10,000 and lends it out to someone who needs a car loan at 7% interest per year. That borrower pays the bank $700. The bank pays you $100. It collects $700. The difference, $600, is pure profit. That gap between what a bank pays depositors and what it charges borrowers is called the net interest margin, or NIM, and it is the heartbeat of every traditional bank on the planet. Now scale this up. A mid-sized bank holds billions of dollars in deposits. It lends those funds out across mortgages, personal loans, auto loans, business loans, and credit cards, all at interest rates far higher than what it pays savers. Mortgage loans typically carry rates around 6 to 7%. Auto loans hover near the same. Credit cards, those interest rates can go anywhere from 18 to 28%. Meanwhile, the average savings account in the United States pays depositors less than 1%. The spread is enormous, and that spread, multiplied across millions of customers in billions in assets, is how banks print money. Now here's where it gets really interesting. Banks don't need to hold all of your deposit in reserve. They only keep a fraction of it, just enough to cover day-to-day withdrawals, and lend out the rest. This system is called fractional reserve banking, and it essentially allows banks to multiply money. Here's a simplified version of how it works. Say 100 people each deposit $1,000. That's $100,000 sitting in the bank. The bank keeps $10,000 in reserve and lends out the remaining $90,000. That $90,000 gets deposited into other bank accounts by borrowers who use it to buy homes, cars, or grow their businesses. Those banks then lend out a portion of that, and the cycle continues. The original $100,000 in deposits effectively generates far more money in circulation, all while banks collect interest at every step of the chain. It is a system built on trust, and as long as not everyone comes to withdraw their money at the same time, it works. Interest is the engine, but fees are the fuel that keeps the tank topped up. Banks are absolutely masterful at charging fees, and most customers barely notice them. Let's walk through the most common ones. Account maintenance fees. Many checking and savings accounts charge a monthly fee just for existing, often between $10 and $25 unless you maintain a minimum balance. ATM fees. Use a machine outside your bank's network and you're getting charged, sometimes by both your bank and the machine's bank simultaneously. Overdraft fees. Spend more than what's in your account, and many banks charge you $25 to $35 per transaction. Banks earned billions in overdraft fees alone for decades. Late
Late payment fees. Miss a credit card payment? The bank adds a penalty charge on top of your already high interest rate. Foreign transaction fees. Swipe your card abroad and a small percentage, usually 1 to 3%, goes straight to the bank. Wire transfer fees. Send money internationally and the bank charges you for the privilege of moving your own money. Individually, these seem small, but when you add them across tens of millions of customers, they generate enormous revenue, often accounting for 20 to 30% of a bank's total income. This is where the really big money comes in, and where banks start operating less like your neighborhood branch and more like sophisticated financial powerhouses. Large banks like Goldman Sachs, Morgan Stanley, and JP Morgan have entire divisions dedicated to investment banking and capital markets. What do these divisions do? When a company wants to go public, meaning it wants to sell shares on the stock market, it hires an investment bank to manage that process. The bank structures the deal, prices the shares, finds buyers, and takes a fee for the service. These fees can run into tens of millions of dollars for a single transaction. When two large corporations want to merge, or one wants to acquire another, investment bankers advise both sides, negotiate terms, and execute the deal, again, earning substantial advisory fees. Banks also facilitate trading in stocks, bonds, currencies, and commodities, earning commissions and spreads on each transaction. Capital markets income is volatile. It goes up in boom times and down in downturns. But in good years, it can be the single largest revenue driver for the world's biggest financial institutions. Here's one more major pillar most people overlook: wealth and asset management. High net worth individuals, pension funds, and large institutions don't just park money in savings accounts. They want their money actively managed, invested into stocks, bonds, real estate, and other assets to grow over time. Banks offer this service through their wealth management and private banking divisions. They charge clients an annual fee, typically 1 to 2% of the assets they manage, in exchange for handling investments and financial planning. JP Morgan managed over $3 trillion in assets at one point. Even a 1% fee on $3 trillion equals $30 billion per year just for management fees alone. This revenue stream is both massive and remarkably stable. Markets go up and down, but clients continue paying management fees regardless. So, let's pull everything together. Banks make money in 4 primary ways. First, interest income. They borrow cheap from depositors and lend expensive to borrowers, pocketing the spread. This is the foundation. Second, fees. They charge for everything: account maintenance, overdrafts, transfers, foreign transactions, and more. Small amounts multiplied by millions of customers. Third, investment banking. They earn massive fees advising companies on IPOs, mergers, acquisitions, and helping corporations raise capital. Fourth, wealth management. They manage money for wealthy clients and institutions, charging a percentage of assets under management. And here's the fascinating part: banks use your deposits to fund all of this. Your money doesn't sit idle. It powers loans, investments, and financial products around the world, while the bank earns on every single transaction. Now you know why banks are consistently among the most profitable businesses in the world. They sit at the intersection of every financial transaction, earning on the way in, earning on the way out, and earning on everything in between. The next time you check your bank balance, remember, that number represents trust. Your trust that the bank will give it back, and the bank's trust that it can keep lending, investing, and growing it in the meantime. If you found this video valuable, hit the like button and subscribe, because next time we're going inside the world of central banks and how they control the entire economy with just one number.